Good morning, everyone. Welcome to this update for global stocks and commodities for the 22nd of September. Over the last couple of weeks, as everybody knows, there's been all sorts of disruptions to the market, from the bombings in the Middle East to the China-US trade war to geopolitical issues. You know, wherever you look, there is all sorts of potential problems. And I think a lot of people are actually buying into this to their detriment and missing out on what are some tremendous opportunities that just continue to roll on. So that's the essence of what I want to cover today. So let's jump into it in this update. Having a sharp perspective is really, really important in a high volatility world, because we are going to see markets continue to move around fairly sharply, both up and down. And unless you have really good conviction about what you're doing, then it's very, very easy for irrational behavior to creep in. It seems rational at the time when you're under pressure, but when you come out the other end and you look back at it in the cold light of day, you find that it was not necessarily in your best interest to sell out or buy in or whatever it was that you did. So it's all about having conviction, and that's very much about having clarity about what you're doing, and having a repeatable process. We've had a more stable week in the week just gone, but large uncertainty still prevails. That's for sure, and I think that's what's sort of disturbing a lot of people. But it's a bit unnecessary in my view. Now, Portfolio Analyst last week, we sort of covered around this issue to a degree, and looked at why this time I think is different, which is always a dangerous statement, but I think this time it is different for long enough to be tradable. So probably different for a few more years yet, perhaps longer, and that's certainly long enough to be tradable. And of course, what is different is that we've got negative interest rates and close to zero interest rates around the world, and seemingly little chance of moving away from that in the foreseeable future. So that's certainly what is different this time round. I also looked at having a realistic perspective on the future, and that really ties back to the first point that I made. And the final thing, amongst a lot of members' questions, I did introduce a local small cap stock that's got immense potential, and that one could be extremely exciting. So let's jump into it. The American stocks. Last week, the index fell by 0.1%, so essentially flat. And we've got this seemingly crazy situation where the economic data is quite solid, but the Fed cut interest rates anyway. I guess what they're trying to do is to anticipate a global slowdown, to anticipate the trade war to have an impact. I'm not really quite sure what it is they're trying to anticipate, but certainly the economic data is doesn't support rate cuts. But we're getting them anyway, and of course the tweeter-in-chief contributed as well, and his comment was something along the lines of "no guts, no sense," and a few other things that I can't recall. But the point about this is, apart from being completely unpresidential, is that Trump's tweets are impacting the market. Whether you agree with it, whether you like it or not, they are. And so we've got to try and negotiate those sort of periodic interjections from Trump as well. Central bank dilemma that they're in, and that is that they can't really raise interest rates if inflation picked up. The fact that they've got very little traditional ammunition left to stimulate the economy. So that's the dilemma that central banks are in. Plus all this uncertainty about whether we have a global recession or a recession in Europe or whatever it is definitely impacting capital-intensive businesses far more. So the manufacturing type businesses, if you look at America, manufacturing is lagging badly. You look at China, manufacturing is lagging. This is very much a services-driven type of economy, and the companies that are doing best are the companies that are what's called capital light. In other words, they don't need a lot of heavy capital investment to grow their earnings. So all this uncertainty is certainly impacting the capital intensive businesses far more, and they're the ones that we should be avoiding because they're the ones that are going to have great difficulty if things do slow down. The US dollar was a little higher, and we saw bonds rebounding as well on Friday. So yeah, it's still very much a backwards and forth situation in the US bond and currency markets. And the 10-year yield was back to 1.72. So let's take a look at the charts. So we'll start with the S&P, and you can see that we've rebounded. So we had a consolidation here between the 50 and the 200-day moving average. We then bounced out of that, have gone back up to the top, had a little challenge at the all-time highs, and have basically just gone sideways for the last 5 or 6 sessions. It's impossible to know which way the market will go from here, whether it will return to the bottom of the trading range around the 200-day moving average, or whether we'll get a breakout. I suspect it'll be very much triggered by something to do with the trade war. If there's a positive signs, we may see a breakout. If there's some negative signs, if things fall in a hole again, we'll probably see the index return back into this zone here. But look, whatever the index does, unless you're trading the index, which I don't, then really you need to focus on the businesses, the growth businesses that can do really well. Let's just look at the small caps. This is the Russell 2000 as well, and you can see it's also returned to the top of that trading range that's been in place for most of this year. US dollar, largely sideways, but just up very slightly on the week. And while I'm here, let's look at the Australian dollar. So we broke this key support here at 68.6. We got down under 67 briefly, and we rebounded to this breakdown area, which it was support. It's now become resistance, and we've turned back down again. So all you can say at the moment is the bigger picture. The 200-day moving average is heading south at a pretty good clip. The price of the Australian dollar, the value of the Australian dollar, is significantly below it. We had a downsloping triangle, which is now broken to the downside. So you can only conclude that the Australian dollar, the direction is heading further south. Now, it may or may not get down into the low 60s, but at the moment, that's the only conclusion that one can make. All right, just while I'm here, let's just look at the ASX 200. So we've had a rebound. We haven't made it back to the late July highs as yet, but certainly a reasonably positive week. And part of that, as we'll see, so the Australian dollar, 67.64, and certainly the local data, the economic data here suggests that more rate cuts are more likely than not. So it's pretty likely we're going to see the RBA move again to the downside before the year is out, which is great for mortgage holders, I guess. As I said, we rallied back to test the breakdown, and now we've rolled over again. Our index was up 1% for the week, so did much better than the US market. And one dynamic that seems to be occurring here, there certainly seems to be some sort of relationship between overseas buying coming into our market when our dollar falls, which I guess makes sense because as far as overseas investors go, when our dollar falls, those stocks are more attractive. My strong advice is to clear away the macro issues, all the things that people are wringing their hands about at the moment, and just focus on growth businesses that are capital light and have got some sort of network effect in play. Stocks like Afterpay Touch and those sort of stocks are certainly trading at very high valuations, but they are very capital light and they have these significant network effects that just compound the growth year after year. So if you focus on those sort of businesses, then if we do slip into a significant Australian or global recession, these are the businesses that are going to continue to march on. And so, yes, everything will get hit in price, but these are the businesses that are going to rebound the fastest and the strongest. And I think in the long run, you'll end up doing far better in these businesses than you will in the capital intensive kind of businesses, particularly ones that are carrying a lot of debt. So they're the kind of businesses that I continue to focus on because they're going to keep growing irrespective of the macro issues. Turning now to precious metals, gold was up quite sharply on Friday to 1,518. It had been under pressure for most of the week as part of the consolidation that I talked about last week that could roll on for several weeks or even several months. But we saw investors back to chasing safe havens again, thanks to this situation with Iran and the bombing in Saudi, and also the trade dispute with China. There was, I believe, a delegation from China to America decided to cancel their trip, and so that got everybody looking at safe havens again on Friday. I'm still expecting there'll be further consolidation because that's how the pattern normally plays out. It won't necessarily be the same this time again, but that's where the likelihood is. So I think buying gold stocks on weakness is the way to go, but I wouldn't expect anything overly marvellous in the very short term. GDX was up by 7.7 for the week, so that was quite a strong week. So let's just look at those gold charts. So we'll start first of all with this is a daily, and you can see nice little spike on Friday thanks to those issues that I mentioned before. And if we look at the weekly, you can get a better sense of it. So I still think we're in this consolidation phase, and that could extend through for another month or two. Seasonally, gold does well into the end of the year from November onwards, so that all sort of fits. If we got a consolidation for another, say, 6 weeks in gold, and then we got another surge to the upside, that would certainly tick a lot of boxes that normally will play out this time of year. And looking at GDX, so this is on a daily chart. We had, as you can see, some strong selling, so we're under pressure for a fair bit. We also got some more selling on Wednesday, but quite a strong rebound on Friday to finish out the week. Turning to other commodities, copper slipped back to 259, and of course there was a huge amount of action in the crude market, which crude oil spiked to over $60 a barrel on Monday. Ended up at 58.13, so it was really all over the place. But just remember, and this is just yet another lesson of not trying to trade the news, remember what the media told us on Monday. Virtually every news show that was out there was talking about petrol prices, and they were going to go through the roof, and we were all going to be penalised, and the sky was going to fall in on Monday. And yet, by basically Tuesday, Wednesday, things had pretty much returned to normal. The Saudis said they'd be back online pretty quickly, and the price of crude oil settled back down again, and I suspect petrol prices will settle back down as well. So trading the news is an excellent way to lose money, and I'll show you what I mean by that. Let's just look at the chart of Woodside, for instance. So if you're trying to trade the news in Australia, this is the price of Woodside on Monday. So it had closed the previous Friday at 31.35. It opened on Monday at 33.84, and that was by a big space, the highest price of the week. And from there, it was all downhill, and it closed down. So if you're trying to trade the news around oil stocks, then it was pretty much a one-way street against you. So just yet another lesson, don't trade the news. This is a spot copper chart, so you can see we had a bit of a spike the week before, but we've settled back down again. And as we've been following nickel recently because of what is happening in Indonesia, the nickel price had a little pullback, but finished the week reasonably solidly. So still sitting around about this $8 a pound, which is a very profitable level for nickel miners. So to wrap it up, my message this week is to focus on opportunities, not all the negative stuff that's out there. And there's an absolute truckload of negatives. Just focus on the stocks that are going to be good, strong growers in the long term, irrespective. And when you look at the traditional value-based investing, and I know that we've seen a rotation globally from growth stocks back to value stocks in the last couple of weeks, and that's been quite a significant rotation. But my bet is that rotation will that'll just be a blip on the radar, and that we'll get some sort of mean reversion back to what we've seen basically for the last few years. Good growth assets will continue to outperform in a low interest rate world, and the lower the interest rates, the more attractive that growth assets will be. And so from my perspective, nothing has really changed, because that's always been the case. Growth stocks have always outperformed. The only thing that's really different now compared to 5 or 10 years ago is that the market's prepared to award a much higher multiple to that growth. But if you look at that relative to interest rates and how stocks are valued, then it's not actually out of line at all. It's just, it feels different, but it's not. Now, Portfolio Analyst upcoming this week, just going to continue to focus on these high growth opportunities. I think this is a very exciting time to be in the market. So I'm not perturbed. Yes, the volatility can be a little disturbing from time to time, but I think there is tremendous opportunities in Australia and indeed in the US as well. So that's it for this week. There's my contact details for any non-members. The $1 trial for 2 weeks is still available on Portfolio Analyst. And I look forward to another pretty exciting week. Cheers.